Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hello everybody.
For those of you that haven't seen our last episode, we talked a little bit about Eugene Fama winning a Nobel Prize in economics. And Mr. Fama has done many studies and about that kind of created index funds. Without going into the whys and the what, but Lauren, can you in a very layman term explain what an index fund is?
Yeah, actually the way I would explain it now is an index fund is basically just taking a snapshot of the market and you get exactly what's in the market.
Okay.
And yeah, that's good enough.
Okay, good enough. So for instance, when they talk about the S&P 500 index fund, what is it?
Right. The S&P stands for Standard & Poor's, but what's important is the 500. The S&P 500 index is the 500 largest U.S. companies.
Great.
So if you buy that index fund, you get the 500 biggest companies, and the proportion of each stock in the fund is exactly equal to its proportion in the general market.
Okay. And then how does that contrast to like an active fund, which are still, even though there's been a much larger increase in the percentage of investors using index funds, there's still a predominance of using active fund managers?
Well, there seems to be more and more active fund managers the less popular active funds get, and their their declining popularity is pretty simple. An active manager is attempting to basically do better than indexes by picking the correct stocks or by timing the market and moving in and out of the stock market at the correct times.
Right. And so as a real simple difference, generally the turnover of the stocks within that fund are much higher in an active fund than an index fund.
Most of the time, because they are trying to do anything to beat the indexes.
Right. And then if an index fund is doing its job correctly, it will generally mirror the index's average less the expense ratio.
Yeah, exactly. Almost day to day, and certainly by month to month, it just moves right along with the actual index.
Okay, and then to finish off this episode in this series, we did a seminar recently, and there were some great questions from clients. And one of the questions was because indexes do change the components inside an index on a given year. What does that do to the portfolio? Does that, for taxes, for trading costs, and things like that?
Yeah, this is a tough question because the person wanted to know, if we use passive management, how we reduce these trading costs when indexes reconstitute. Okay, briefly, we don't use strict index funds. We use structured passive funds. And one of the things about those funds is that, for instance, when we have a fund that invests in small company stocks, maybe if you can imagine below this line is all the small company stocks that are the 20% smallest.
Okay.
And then up here is maybe the 25% smallest.
Okay.
As stocks move, a stock might move in and out of this index. The funds buy it when it's beneath 20%.
Right.
They don't sell it until it goes above 25%. So that prevents you from buying and selling, buying and selling, buying and selling. As the stock gets big, a little bit bigger and a little bit smaller, a little bit bigger and a little bit smaller. And so there's a little bit of a wiggle room, and that reduces trading costs. So the funds that we use don't exactly mirror indexes. We do many things. This is just one example, but the funds do many things to reduce trading costs as low as possible.
Right. And then to finish up with that, because they're not strictly tied to that index, there is the thought that if, let's say, every index fund out there knows that XYZ company is being dropped from the index, that'd be like the absolute worst time to have to sell it. Sell it at the same time. So the advantage in layman's terms for our structured fund is we can wait until maybe we don't even replace XYZ fund, or later on we will until after the turmoil kind of subsides. Yes. And then just to finish this off, because that was a great question from our client. But I want to be really clear, even with changes in indexes, the amount of turnover in our portfolio is significantly less than the typical active fund.
And in fact, it's lower than the average index fund, which is pretty impressive.
Okay, well thank you very much for watching this episode of Erickson TV. We'll see you next time. Bye now.
See you next time.